Hello, greetings. Welcome to Dividend Blasters. This is our 102nd video and topic today, Nav Erosion. Do not get fooled by high yields. So, it is very easy as an investor, an ETF investor, a covered call ETF investor, to be seduced by high distribution yields. Because you're thinking, hey, the distribution's higher, I'm going to get paid more. That's great. What you got to realize is there is a cost for that yield, and that cost is NAV erosion. All covered call ETFs have NAV erosion. Some just do a better job of managing it. Some care about it more than others. So, our objective is to cover the key considerations for investors when choosing to invest in a covered call ETF. All right. First, a disclaimer. What I say is not financial advice. This video is for information and education. It reflects my own personal opinions, research, and experience as an independent investor for more than 30 years. Do your own research, your own due diligence, and consult an advisor before making any major financial investment decisions. So, last few videos, we've been talking about NAV erosion. And I've been highlighting a couple of covered call ETFs that I like, a couple I like more than others, a couple that I find to be better suited for bullish market trends versus bearish market trends, and that I happen to invest in both. What I'm going to talk about today is I'm going to step back even more than I did from the last video where we talked about best practices. And I'm going to kind of, you know, go back to a fundamental foot stomping here of redefining for everyone what is NAV erosion. And if you haven't watched any of the videos, that's fine. This is a great video to start, and you can go back and watch the others. But for definitional purposes, what is NAV erosion? NAV erosion is the gradual decline of a fund's net asset value over time. This is most commonly seen in high yield covered call ETFs that pay out income in the form of distributions to investors that exceed what they can sustainably generate. And basically, that is coming from the premiums through their option overlay strategy, or replenish through asset growth. So, how does a covered call ETF grow? Well, it grows through price appreciation. And what prevents price appreciation? Price growth, capital growth. In a covered call ETF, what prevents it are options being assigned and the shares being called away. And that has a lot to do with strike price strategy. And I talk a lot about this in the last few videos. So you're looking at two things happening here cause NAV erosion. You can basically the asset value is not growing; it's not being replenished. Uh, Also, the premiums that are being generated are not sufficient to cover the distributions that are being paid out to investors. All right, let's keep pressing on. I love this stuff. It's exciting. So, why is this significant? NAV erosion refers, first of all, to the shrinking asset base or the net asset value of a fund, which is what I just said. The asset base shrinks when distributions, like from options premiums from covered call strategies, are paid to investors that exceed the income generated. So, quite simply, the management team of the ETF is paying out more than they're collecting. Very simple. That's one. And I already mentioned this. I'm going to mention these again because I think it's so important to get these down. Or the fund's underlying assets are not growing fast enough to sustain those payouts. Okay? So if they're not growing fast enough and the distribution percentage is a percentage of the asset value, guess what? The distributions are going to decrease. Impact. This affects the ETF's ability to generate future income. I just said this, and can result in capital loss for investors who sell at a lower NAV. So guess what? If you're holding on to a covered call ETF and that underlying value of it is decreasing, even though you're getting your premiums, the premiums are going to shrink because the value of the asset's going to shrink, and very likely the price is going to shrink. And if you decide to get out because you're unhappy, you're going to sell for a loss. Why does NAV erosion occur? And I've touched on these. I'm going to hit them again. Regular payouts exceed growth. Quite simply, high-yield option-based ETFs. They often overdistribute income so that it is greater than any gains from the options or from the asset growth. It drains the principal, quite simply, of the fund. There's limited upside. Here's the other piece around options overlay strategy. Covered call strategies cap potential upside because if the underlying stock rises, gains above the strike price are forfeited, limiting asset growth. It's very simple. Very simple. If you set a strike price that is breached by the market price in your options contract, the option will be assigned and those shares will be sold. And the market price will still keep going up, but the upside is missed. It's missed by the investment firm, and it's also missed by you as the investor. Market declines. If the broad market or underlying assets decline, the income from options may be insufficient to offset losses, accelerating erosion. So if the price goes down, the market goes down, guess what? The distribution is going to go down, very likely. Aggressive yield targets. Funds that target extremely high or fixed yields may pay out capital when premiums fall short, directly eroding NAV. So it's quite simple. Basically, you're overpaying versus what you're collecting, right? Hey, it's very simple. You got to earn more than you spend. We know it as consumers, and the same goes for these ETF management teams. So, what are some prevention strategies that ETF management can take? Well, they need to be flexible. They need to be active in how they manage the fund. Adjust the options strategy based on market conditions. So basically, when you're in a volatile market or you are in a bull market, pull back a little bit. Okay, that will actually help mitigate erosion. How does it do that? If you are a little bit more strategic on how you set a strike price, less likely that the option will be assigned and the shares will be sold. You don't want to miss out on upside. So remember, growing the asset is about getting upside, retaining the shares, also generating sufficient premiums to grow the value of the asset, also not overpaying in the distributions to the investors. It's all of those things. And everything I just said is below, but we're going to go through these. Sustainable yield targets. Funds should avoid overpaying distributions. Very simple. And certainly don't pay more than you are generating from your premiums that you're collecting. It's all about preserving the NAV stability. That's it. Think about this. When you are paying out a distribution, and this goes for all covered call ETFs, you are actually drawing down from the NAV. But some funds are better at managing that than others. A fund that is better at capturing upside can withstand paying out distributions and maintain the NAV much better than a fund that misses upsides or under collects or over distributes. Another one, avoid synthetic positions. And I did talk about this a little bit in the last video. Synthetic covered call structures can exacerbate NAV erosion. Sticking with physically covered call positions helps reduce risk. So, quite simply, managing a synthetic position can be expensive. There's NAV decay issues. The total return perspective. Reinvesting, and this is really important, reinvesting distributions and focusing on total return, including both income and changes in NAV, can soften the impact for long-term investors. So I'm actually I'm gonna talk about total return, and I'm also going to talk about fully reinvesting. And so, for instance, let me say this: it's beneficial to the investors if the fund is reinvesting a good portion of the premiums and not overpaying distributions to investors. I'm going to talk about this in a few slides from the investor perspective, but I'm going to flip it on its head because there's a trick that I wanted to share with you, but we're going to wait a few slides. Preferred fund structure. There's another strategy. Seek funds with policies that prioritize NAV preservation and NAV stability, such as those that limit distributions to actual option income or employ buy and hold with moderate call writing. So, what does that mean? Basically, you want a methodology from the management team that is basically basing what they pay out in distributions to be aligned specifically to the collections, and not all of them, but some of them. And how much you pay out, that's totally up to the fund. And that'll be up to the investors and what they decide to invest in. But certainly do not dip into the principal. So do not pay out distributions that are more than the collections, because then you're dipping into the principal and you're draining the principal of the fund. You're draining the assets. You're draining the capital. Don't want to do that. That gets you to NAV erosion. So these are things you do um, as a management team and of an ETF to avoid that. And these are things you look for as an investor in a covered call ETF. It's good to ask these questions, think about them, research. Key risks for a covered call for ETF investors. Um, Basically, as the asset base shrinks, or I called it the principal or the underlying asset or the capital, as it shrinks, future income, basically the distributions are going to shrink. They have to, because as the assets get smaller, they can't pay out as much. Capital loss if liquidating at a lower NAV. I talked about this. If the asset value is decreasing and you decide to sell it, very likely the price is decreasing and you will basically sell it for a loss. You will lose your money. And this here really goes back to the point I made on the previous slide about aligning what you pay out with what you collect. Distributions may include a return of capital rather than the true income, especially when market conditions are unfavorable. So, maybe an ETF management team wants to maintain a particular distribution percentage, which is very difficult to do. Maybe they can set an annual percentage, and that's great. But trying to maintain that month to month and certainly week to week, I think is absolutely impossible because of market fluctuations. You need that flexibility. If you're trying to maintain a set percentage every month or every week, you will likely be draining the capital. You will basically be dipping into the principal, dipping into the assets, which basically means they are selling those assets, those underlying assets, to generate cash to pay out distributions. And that will actually erode the net asset value. No good. No good. You want to watch out for that. So, what do I do? And I've talked about this in a few videos. I invest in a handful of covered call ETFs. I actually invest in more, but these are four that I have been investing in for a while, and there's enough data where I'm comfortable talking about. There's two from Goldman Sachs, GPIQ and GPIX, and then there's two from neosinvestments, QQQI and SPYI. Two of them basically replicate and sell options against the NASDAQ 100 index, as well as some of the holdings. Two do the same, but only for the S&P 500. You can see the expense ratio here, and I've talked about that in previous videos, That's basically what it costs the management team to run the fund. And for you as the investor, those are basis points. So for every $10,000 you invest, like in GPIQ, you're paying $29 a year. Same thing for QQQI. There's a little higher at 68%. You can see the inception dates of when they started. These are both, all four of them started back in 2023 and 2024. One started back in late 2022. And you can see how much assets they manage. They're all billion-dollar funds. Neos is a little bit bigger. They've had a little bit more success in attracting investors. I like them both. I like all four of them. They're good. And I've mentioned why I invest in both in the last couple of videos. And go back and listen, and you'll find out why I invest in all four. So here is interesting to see them side by side, the dividend yield or the distribution yield, really, for one of the four. And you can see they're all basically paying out monthly. But GPIQ and GPIX, theirs are a little bit below 10%. QQQI and SPYI, they're a little higher. They're in the 12 and 13% range. And that really goes to strategy, whereas QQQI and SPYI are really more focused on being an income delivery covered call ETF, whereas GPIQ and GPIX does that, but to a lesser extent. They're really more focused on capital growth, if you will, and capturing additional upside. I think they both do a good job. All four of them do a good job. I will say here and now that these four covered call ETFs do not have issues with NAV erosion, which is why I invest in them. And I know that for a variety of reasons. But let's take a look. You can actually see the four side by side. Look at the price return for the Goldman Sachs ones. It's a little bit higher than the Neos ones. And that's not surprising because, like I said, the Neos covered call ETFs are more focused on income, whereas the Goldman Sachs ones are more focused on growth. And I'm looking at the 1 year time frame, and I've done this for multiple time frames in other videos. You can go back and check it out. And here is total return, where it actually gets a little bit more narrow. They're much closer when you look at total return. Neos actually makes up some of and it says price return on the slide, but it's really total return. Neos actually makes up some of the deficit with the higher premiums. So these four are real winners, and they're clear cut. What you should do is always look for an increasing NAV. Now, you know what? There's other resources out there, and I like to use Morningstar. And so when you look at total return NAV, you see positive figures for total return NAV. A real test of this is to look over a longer time horizon. And I would like to look at 3 year, 5 year, and 10 year. I really can't do that for these because they're too new. But you're going to see positive NAV for 1 day, 1 week, 1 month, 3 month, year to date, 1 year. You're going to see this for all four of these. Okay. And so, that's great. I'm convinced, but what about the ones that I do know for a fact don't have great NAV returns? What do you look for when you know about NAV erosion? Because when I look in, and this is Morningstar, it all looks positive. And I know that the yield max covered call ETFs, they tend to be they pay high distributions. They have NAV erosion issues. I just know that. But look, the total return tends to be positive for the most part, except you see a negative for year to date. So that's Tesla. That's part of the yield max family. Here's YMAX, which is kind of a consolidation of other yield max funds. The total return, NAV total return is positive. Okay, but I know that these tend to be, they have NAV erosion. I just know it. I talk to people. So, QDTE. Now, this is another one. This is by Roundhill. I know that this has NAV erosion, but look, total NAV return is all positive. So, if I could look at 3 year, 5 year, and 10 year, I could look at trends and I'd say, hey, look at what's going on over the years. What happened from the last 5 years? Did it go down? And that's what I would look for. But, these are too new. I can't tell. So a quick and easy way to do this is basically not to be to look a little deeper, but also to make it simpler. But let me go back here. Why is this happening? Why are these all positive? These are all positive because we have something called masked NAV, and you have masked NAV because investors are they're dripping in all of their distributions. So even though there is NAV erosion, and I know that for a fact, um, they're collecting more, funds, and it's driving up the NAV every week or every month, even though they are basically over distributing. And I know that. I'm going to show you that in the next couple of slides. But basically, that's masked NAV. Okay, that's basically you can look at the NAV return of Morningstar, and they're all going to look hunky dory unless it's really bad. Um, but what you have to do is you have to look beyond that. And like I said, listen, um, they could be over distributing, but if the funds are being reinvested, it's not always clear. So an easy way to do this is to compare the total return to the distribution yield. And it's great if you can look at it over multi years. But sometimes these things are new, and you can't look at 3 and 5 and 10 years. So I'm looking at 1 year. So take a look at this. Look at the four that I invest in. So GPIQ, GPIX, QQQI, and SPYI. And the question is the total return greater than the distribution percentage? So the total return is basically an indication of price appreciation plus dividends. So price appreciation is growth. Dividends are basically what they're paying out. But you do not want the distribution of the fund to exceed the total return. So take a look at GPIQ. Distribution is a little under 10%, total return almost 23%. So that's good. That's a green. That means I invest in that. GPIX, same thing, 8% versus 17%. QQQI, same thing, 13.6 versus 23%. SPYI, same thing, 11.7 versus 16.4%. You do see that there is a little bit of a narrowing with the NEOS funds, and that's really because of underlying market conditions. We're in a very bullish market right now. If we were in a bearish market, you would see this thing flip, which is why I invest in both the Goldman Sachs and the NEOS. Now, take a look at the two yield max funds and the Roundhill fund. Look at those distribution percentages. YMAX, 65.86%. Total return, less than half. I'd say no. Tesla, 105% distribution. Total return, 43%. That's telling me that a lot of people are dripping and reinvesting in Tesla, but it's not enough because, you know, I'll tell you what, the distributions are too high and they are missing a lot of upsides in their option trades. So their options overlay strategy is doing that. And also they have a high net expense ratio. QDTE, the Roundhill one, it's a little bit better than the other two, but still, the total return is less. It's about a third less than the distribution percentage. I actually used to invest in QDTE for a while. I started thinking through this stuff a little bit. I said, no. Getting a weekly dividend is nice, but our distribution is nice, but it's not as important to me. So that's kind of where I am with this. So this is really a quick way. Look at the distribution percentage. Look at the total return. If the total return is exceeding the distribution percentage, you do not have real NAV erosion. If distribution is greater than total return, you do. And that is it, folks. I hope you found this to be informative and useful to you. Before I close, just a reminder that as a affiliate partner seeking alpha, I offer discounts. I can extend them to you for the premium subscription Alpha Picks, as well as the bundle premium. You get wonderful, insightful, up-to-date analysis and quotes on leading stocks and ETF ETFs alpha picks, you get 2 free picks every month. I can get you a discount. And so go ahead and click on the link, click on the QR code, and you will see the wonderful discount I can get you. I will mention for Seeking Alpha Premium, it's a 7-day free trial. If you try it out, you don't like it, you cancel it. No harm, no foul. But I think you will like it. And then you can get the bundle, which is both. And I actually have both. I'm an investor and a longtime subscriber. I'm a longtime subscriber of the premium and Seeking Alpha. If you're interested, check us out. We're on other platforms, X, Instagram, and Facebook. Those are my handles and my QR codes. Have a wonderful day. Until our next video, God bless.